Imagine opening your trading app and realizing that you don't need thousands of dollars to own a real American company. Not a startup from nowhere, not a risky scam, but an actual US-listed business that trades on a major exchange. Most people believe investing in the US stock market is only for rich investors who can afford $200, $500, or even $1,000 per share. When they hear names like Amazon, Tesla, or Nvidia, they immediately think investing is out of reach. But what if I told you that there are companies in the United States whose shares are available for almost the price of a casual dinner, roughly around $20, and these companies are still operating, still earning revenue, and still part of the world's largest stock market? Here's the interesting part. Many investors completely ignore these kinds of stocks. Why? Because the price doesn't look impressive. A $20 stock doesn't create headlines. It doesn't trend on social media, and it doesn't give the feeling of owning something premium. But history has shown us again and again that stock price alone does not define a company's future. Some of the biggest winners in the market started at prices that most people laughed at or ignored. The difference between people who succeed in investing and those who don't often comes down to one thing: understanding value before the crowd does. Now think about this for a moment. If a $20 stock moves to $40, that's a 100% return. But when a $400 stock moves to $440, the percentage gain is much smaller, even though the price change looks bigger. This is why smart investors pay close attention to affordable stocks with strong fundamentals. They understand that the real game is not about how expensive a share looks, but about where the business is heading over the next few years. And today, we're going to talk about one such US company whose stock is trading around $20 and why it deserves your attention. Before we go deeper, let me make one thing very clear. This video is not financial advice. I'm not here to tell you what to buy or sell. My goal is simple: to help you understand how these affordable US stocks work, why some companies trade at these price levels, and what kind of opportunities and risks come with them. Especially if you're a beginner or someone who feels left out of the US stock market because prices seem too high, this video is made for you. On this channel, we focus on breaking down the US stock market in a simple and realistic way. No complex jargon, no hype, and no fake promises. We talk about real companies, real numbers, and real risks. In today's video, I'll walk you through what this $20 US company actually does, how it makes money, why the stock is priced where it is today, and what could potentially push it higher in the future. At the same time, we'll also talk about the risks that most people ignore, because understanding risk is just as important as understanding opportunity. So stay with me till the end, because by the time this video is over, you won't just look at a $20 stock the same way again. You'll understand why price is just a number, why opportunity often hides in boring places, and how smart investors think differently from the crowd. If you're serious about learning how to find affordable US stocks with real potential, this video could change the way you see the stock market forever. When people hear about a US stock trading between $10 and $20, the first reaction is often doubt. Many assume that if a stock isn't expensive, the company must be weak, struggling, or close to failure. But that assumption is one of the biggest misunderstandings in the stock market. In reality, a stock's price is only a small part of the picture. What really matters is the business behind that price, how much revenue it generates, how it's positioned in its industry, and whether it can survive and grow over time. Some companies remain in the $10, $20 range not because they are bad, but because they are in rebuilding phases, early growth stages, or simply ignored by the market. Take Ford Motor Company as an example. This is not a startup or a risky unknown name. Ford has been around for more than a century and still trades in a range that often sits below or around $20. The reason isn't that Ford is irrelevant. It's because legacy automakers operate in a highly competitive, capital-intensive industry. Ford generates massive revenue every year, sells millions of vehicles globally, and is investing heavily in electric vehicles and future mobility. The stock price reflects slow growth expectations and economic sensitivity, not a lack of real business. For long-term investors, this shows how even a globally recognized American brand, can sit comfortably in this price range. Now consider Palantir Technologies, a company that became famous for its data analytics platforms used by governments and large enterprises. Palantir often trades between $10 and $20 despite having cutting-edge technology and long-term contracts. The reason is profitability concerns and investor debate over valuation. Palantir earns revenue, but the market keeps questioning how fast it can scale profitably. This creates volatility, which pushes the stock into a price zone where long-term believers and short-term traders constantly battle. This is exactly why such stocks attract attention from investors who are willing to wait. Another name that often comes up in this range is Solfi Technologies, a financial technology company trying to become a modern digital bank. Solfi offers loans, investing, credit cards, and financial tools under one platform. Its stock has spent time moving around the lower double-digit range because the company prioritizes growth over profits. The market wants proof that Solfi can consistently generate earnings, but its expanding user base shows potential. Stocks like this remind us that growth stories are rarely smooth, and price often reflects uncertainty more than failure. Snap Inc., the parent company of Snapchat, is another interesting example. Despite being a widely used social media platform with millions of daily users, Snap has often traded between $10 and $20. Advertising revenue depends heavily on economic conditions, and any slowdown hurts investor confidence. But the business itself is real, global, and still evolving. This shows how even tech companies with massive user bases can stay in this price range due to market sentiment rather than lack of relevance. Then there's Peloton Interactive, a company that exploded in popularity during the pandemic and later crashed when demand slowed. Peloton's stock has frequently traded in the teens as investors reassess its future. The company still has a loyal customer base, subscription revenue, and a recognizable brand. Its stock price reflects a reset of expectations, not a complete collapse. This is a powerful lesson in how hype fades, but businesses don't disappear overnight. Electric vehicle companies also dominate this range. Lucid Group, for instance, is often priced in the low to mid-teens. Lucid produces luxury electric vehicles and has strong backing. But high production costs and slow scaling keep investors cautious. The stock price reflects long-term hope mixed with short-term execution risk. Similarly, NIO, another EV name traded in the US, often sits in this range due to global competition, pricing pressure, and geopolitical concerns. These companies show how innovation alone doesn't guarantee high stock prices. Telecommunications giant AT&T is another classic example. AT&T has been a household name for decades, yet its stock frequently trades under $20. Why? Because it's a mature company with slow growth, high debt, and intense competition. But it also produces steady cash flow and pays dividends. For many investors, AT&T represents stability rather than excitement, proving again that price does not equal importance. DraftKings is another stock often found between $10 and $20. It operates in online sports betting, a fast-growing industry in the US. However, heavy marketing costs and regulatory challenges keep profits under pressure. Investors see massive potential, but they also see risk, which keeps the stock from rising too fast. This balance between opportunity and uncertainty is exactly why it sits in this price zone. Even companies like Under Armour, a well-known American apparel brand, have spent long periods trading in the teens. Despite global recognition, changing consumer preferences and intense competition from Nike and Adidas limit growth expectations. The business exists, generates revenue, and continues to adapt, but the stock reflects modest optimism rather than explosive growth. What all these companies have in common is not weakness but complexity. Their stock prices sit between $10 and $20 because the market hasn't fully agreed on their future. Some investors see opportunity, others see risk, and that disagreement creates a stable but volatile price range. This is where patient investors often pay attention. Not because these stocks are guaranteed winners, but because they offer a realistic entry point into real US businesses without requiring massive capital. It's also important to understand that a $15 or $18 stock can double just as easily as a $150 stock, sometimes even faster. Percentage growth matters far more than price. At the same time, risks are real. These companies can fall just as fast if earnings disappoint, economic conditions worsen, or management fails to execute. That's why research, patience, and position sizing matter more than excitement. When you look at stocks in this range, you're not gambling on dreams alone. You're analyzing companies with real products, real customers, and real challenges. Some will recover and grow, some will stay flat, and some may fail. But this is how the stock market has always worked. Opportunity doesn't come with certainty. It comes with informed risk. By understanding why these American companies trade between $10 and $20, you begin to think like an investor instead of a gambler. You stop chasing hype and start asking better questions. And that mindset shift is far more valuable than any single stock pick. At the end of the day, the stock market doesn't change lives overnight, it changes lives quietly, slowly, and often when nobody is paying attention. The biggest mistake most people make is waiting for the perfect moment or the perfect stock, while real opportunities pass right in front of them. A company trading around $10 or $20 may not look exciting today, but neither did many legendary stocks before they proved the world wrong. What matters is not how loud the market is, but how clearly you can see through the noise. If this video helped you think differently about affordable US stocks, then you're already ahead of the crowd. Stay patient, stay curious, keep learning, and never underestimate the power of small, informed decisions made consistently over time. This is not just about money, it's about building confidence, independence, and a future you control.